Well, usually Kim or Nick are here to introduce this esteemed guest that we have today. They are esteemed hosts, I should say, and all along those lines. But I am a great admirer of Peter Bennett. He is definitely involved in over 17 years of financial experience, and he has actually had the privilege of being both a lawyer and a financial planner, and has done a lot of amazing work, even having worked on the Wall Street. And oftentimes, when I think of Wall Street, I think about the TV imagery of Wall Street and all along those lines. But he's actually been there in the very difficult working that environment. So I'm glad to bring on our amazing host and all along those lines. But we got Kim with us, so Kim's here. I was trying to do Kim's job, but all in that space. But definitely we've got Peter Bennett. So I'm gonna bring Peter Bennett on, and Peter Bennett will be sharing his tremendous knowledge and all of this great things that he talks about. He's got me thinking about energy. He's got me thinking about these amazing pills that he's been talking about and a lot of other things as well. So I've actually been thinking about getting invested in some things that he's been talking about. I haven't made that investment as of yet. I'm actually been attending an event that deals with the economy here in Durham, North Carolina. So they were having all kinds of conversations that I participated in yesterday. And I might be going into that later on this afternoon because there are folks from all over the country, ranging from Tacoma, Washington to Utica, New York, to a number of other parts of the country as well. So it's a 3-day conference, and I had the pleasure of attending it yesterday, and I'm hoping to attend some of it today as well. So glad to see you, Peter. You're amazing.
Hi, Mark.
I'm glad to be able to do a quick introduction, not as flamboyant as, even though I got the media background as Kim and the way that Nick do it, but
Mark.
I have a great deal of admiration for you.
Okay, thanks, Mark.
Well, we just got the one and only Wall Street hacker who got his economics degree at UCLA. He received his law degree at the University of Miami. And then he attended NYU to get his MBA and then worked in Wall Street for 17 years and is bringing us his experience on how we can survive investing in these economic storms. Peter, it is such an honor to have you here on Pod TV, and I'm going to hand it over to you.
Oh, thanks, Kim. So welcome to Wall Street Hackers, May 16th, 2024. You can catch a new episode almost every week on Thursdays at 1, starting at Thursdays at 1, or Saturdays, depending on your distribution channel. By the way, just a quick mention, the CFP approved one of our shows for broadcast recently, and that, I'm told, is a very high honor and very difficult to achieve. So it was nice to hear that. The markets. There's been a slight upward movement in the S&P 500, but there's a bunch of points. Number one, the market was especially excited this week when the CPI Consumer Price Index came down from 3.6 from 3.8. But the market is like that, and it had been for years when it thought, oh, there's going to be 7 rate increases this year. It tends to be a little delusional even now. So they ignored a couple of points. Number one, the PPI, the Producer Price Index, had a very large increase. It was 0.5% for the month, much higher than the 0.3% forecast. That's a 6% annualized rate by definition, but also the PPI presages increases in the CPI many times because that's the cost of manufacturing goods. The other point they seem to ignore fairly much is Chairman Powell said, quote, "We did not expect this to be a smooth road, but these inflation readings were higher than I think anybody expected. It is more likely we will hold the policy rate where it is." So the delusional market, just looks for everything positive. But I would say that it's not that I think the market is going down now. I think it went up a lot. And by the way, I want to point out one last thing. The market was at, the other point was the market was at, based on the S&P 500, was at SPY 471 on 12/20/21. So in 2.5 years, it's up 12.5%, which is a lot better than a few weeks ago, but that's basically about 5% a year. So you could have been in bonds and gotten the same return. And against inflation, basically, you're not going anywhere. So not far, certainly. And that was including the Magnificent Seven, who had an outstanding performance. So if you took away those, forget it, in terms of losing to bonds or inflation. So even though they keep reporting in the news that new highs, it's not that remarkable in terms of the actual progress we've made in 2.5 years, basically none against inflation. So the other point I bring out is Wall Street Hackers is not against the market. I mean, I think it just shows you that if you want to do well in the market, you better pick the right sectors, pick the right stocks, and that it's going to be a tough going in the future, because as bad as inflation has been, I think we're likely to get more inflation, especially against real rates, and stagflation, which will be even a harder investment. So you have to be selective, obviously, as always. In a separate story in the market, this could be a long-term concern to some tech companies, at least to them, and some other sectors. 2 Chinese chip producers are in early stages of manufacturing high bandwidth memory, or called HBM semiconductors, used in AI chipsets. The HBM semiconductors are older versions, but represent vital step forward in China's push for reduced reliance on foreign supplies. A couple points there. One, if China develops chips that work, they'll stop buying them from other countries. 2, that's what they have a history of doing. They kind of steal ideas and build up their own sectors, and they subsidize those. And it would even create competition in other countries for chips. So, these chip companies are valued as if they'll grow tremendously. And maybe in the next 5, 10 years, whatever, China starts infringing on their monopoly or semi-monopolies. Quote of the week. Goldman Sachs CEO David Solomon said, quote, "I think the level of debt in the United States and the level of spending is something that we need a sharper focus on and more dialogue around. The spending levels are continuing at a pace that I think is raising our debt level and creating issues for us down the road. The issue is something that deserves a lot of attention." Well, Wall Street Hackers agrees, of course. We've been shouting about the debt, as some people have been for a long time now, for a couple of years now. But the thing is, I think that's understated. The U.S. debt, as we point out often, is not the $35.6 trillion that you'll hear every day all over the place on the financial news. I heard it today on Bloomberg Radio. It's not $35.6 trillion. The debt they should be talking about is $125 trillion roughly. Why is that? Because on a GAAP basis, the same basis that households have to use, businesses have to use, generally accounting principles, you have to count Social Security and Medicare unfunded liabilities. Other countries around the world, everyone I've checked, and I've checked a lot, have almost exactly the same issues. Huge unfunded liabilities for demographics that are getting older. They haven't put any money aside. Free healthcare for aging populations, it's going to be expensive, and it means a lot of money printing. What to do? Well, our advice here never changes, more or less, for the last few years, and there's no reason it should, because it's been right, and it probably will be. 1, own energy and pipelines. 2, let's go back to that one. 2 points about energy and pipelines. Data centers are going to increase the need for electricity usage, and this is a fact. In 2022, 2.5% of U.S. electricity use was from data centers. In 2030, it's forecast to be 6.5 to 7.5%. That's going to use a lot of electricity. The other thing is, as EVs expand, they're going to need electricity too. So this trend is going to help not only energy producers and pipelines, but also some utilities. And I'm going to be getting in the next weeks into some utility picks along with some energy picks. Second, you have to own dividend payers if you believe in history at all, because our favorite chart, which I have to bring this up actually online again because I've shown it so many times, but also I've only talked about it. But for 50 years, from 1972 to 2022, dividend payers doubled the performance of the S&P 500. That's huge compounded. Tripled performance for the dividend growth and initiators. And non-dividend payers performed extremely poorly. It was ridiculous how they got blown away by the dividend producers and initiators. So you want to be in dividend producing stocks, which are also very healthy, because if you have a nice dividend coming in, you don't panic and sell like some people do. Third, you have to be very defensive. It's always good to be selective and defensive when you can be, but you want businesses that are going to do well in an inflationary and very likely inflationary environment, and stagflationary environment too, because inflation is coming relative to rates. Rates are going to be low, inflation is going to be higher, and returns are probably going to be very soft in terms of returns against inflation, and very likely stagflation. It's not a great environment to be investing in, unless you pick the right ones. So we'll take a very quick, we won't, sorry again. So interesting stories of the week. We still have a section here, 5 most interesting stories of the week. Number 1, as well published in the news, the U.S. recently withheld high payload bombs to Israel. Here's what President Biden tweeted in 2019, and this is a quote. President Trump withheld congressionally appropriated aid to Ukraine unless they granted him a political favor. It's the definition of quid pro quo. This is no joke. Trump continues to put his own personal political interests ahead of the national interest. He must be impeached. Obviously, you can just substitute the 3 words, Biden for Trump and Israel for Ukraine, and Biden's own words says he should actually be impeached. They may be loosening that up finally, but they have been withholding funds from Israel and supplies to Israel. And I would point out just 2 differences. One, Biden withheld aid from a U.S. ally, arguably, but not certainly, but arguably for political reasons, basically swing state voters in Michigan. Trump had a legitimate reason, without a doubt, and a very strong U.S. interest to ask why, at least to ask the question, why Biden family was getting millions of dollars from Ukraine, why Biden bragged publicly on television. You can probably still find this on Google. He said, I got the prosecutor in Ukraine fired. Like, he was bragging about this. Now, that prosecutor happened to be going after Burisma, where Hunter was working and paying him millions of dollars. So that seems like a conflict, and a lot of issues are obviously raised by that, but it also seems a little legitimate. And Trump was actually impeached for that. Brilliant. Number 2, interesting story. A perfect example of fake news. As you know, Wall Street Hackers hates fake news, and it's all over. But math doesn't lie. So for many weeks, the mainstream media has been reporting Hamas figures saying 30,000 have been killed in Gaza. Now Hamas is saying 35,000 killed in Gaza. I Googled it yesterday. Reuters, 35,000 killed. CNN, 35,000 killed. CBS News, 35,000 killed. That's what Hamas said. Except now the UN, even using figures from the Gaza Ministry of Health, which has very close ties to Hamas, is saying that the confirmed death toll is 22,700. That is still based on a Hamas-influenced organization, but I've been wondering all along, just because Hamas says it, are they reliable? I believe they're considered a terrorist organization. So maybe they have an incentive to up the numbers a little bit. Interesting story number 3. Well, the Biden administration did something right, in Wall Street Hackers' opinion. A new executive order, 14067, passed by the Biden administration, is promoting a new central banking currency known as FedCoin. Some private policy institutes like the Cato Institute is warning that it's going to create government control, possibility of freezing assets. But I don't think that's a problem because the government really has control anyway, and they probably should have access in many cases to the financial system and what's going on. But Wall Street Hackers has been saying forever, for the last 2.5 years, we believe Bitcoin and crypto are one total speculation. It could go to $1 million or zero, but there's no fundamental value. But we believe governments of the world need to stop crypto quickly, or as soon as they can. One, it empowers criminals and the black market. Two, it allows for the creation of money, which is supposed to be the Fed's job and other European and other institutions. So you can't lose control of the creation of money. And in a sense, they create money if the value of crypto goes up. And that could be fueling inflation too. So Wall Street Hackers has also been saying for years that the creation of government-backed cryptos, and they've been created more and more by credible countries, are going to threaten crypto itself. So I believe this will also hurt crypto. Why? Because Bitcoin, which is supported by a promise from Satoshi Nakamoto, and they promised never to issue more Bitcoin, but nobody knows who he is or if he exists. So I would trust digital currency by a full country a lot more than Satoshi Nakamoto. Interesting story number 4. Republican strategist Karl Rove shut down speculation that Michelle Obama will replace Biden in the 2024 election, calling it, quote, pure lunacy. I've had a sense that she doesn't like politics, but he kind of confirmed it. And of course, anything can happen, so maybe she will step in. But I don't think so, and Rove doesn't think so. Rove slammed the idea, saying that she resents politics and was not even in favor of her husband, Barack, running for public office at all. He said, quote, no, look, she hates politics. You read her autobiography. She didn't want her husband to run for the state Senate. She didn't want him to run for the president. She is not a political animal. And I would say, like my wife has very little interest in politics. And if you don't love it, you don't want to get involved. It'd be a big responsibility for her to go back to Washington. I don't think she'll do it, but you never know. Finally, interesting story number 5. Protesters and colleges may pay the price. The union representing Columbia's custodians is planning to sue over the university's indifference and negligence regarding the safety of its members who were trapped in the building. The union may be planning to sue protesters too. George Washington law professor is predicting many more lawsuits against protesters and their backers. If DAs won't prosecute, victims can sue for false imprisonment. Victims of protests include not only students and faculty, but people trapped in their cars by road blocking protests, causing people to miss flights or missing work or medical appointments. It only takes one person to launch a class action suit. Universities themselves will likely face civil rights lawsuits. I'd be surprised if they don't. A New York Post reporter said, quote, this could be a sort of full employment act for civil rights lawyers. So this could be the new trend for lawyers to jump into this. And there could be so many suits, and protesters may pay through the civil system. We'll take a quick break, and then we'll be into the dividend pick of the week and our panel discussion. See you soon. Or not.
Welcome. Today we're going to look at a unique tax planning opportunity using life insurance to create huge tax deductions for 2020. So listen up to this not well-known plan called 412E3. Today I have a very special guest, Max Culiet, who's a certified financial planner and a registered investment advisor to help us with understanding 412E3 plans. Max, welcome to the show. What is a 412E3 plan?
Well, thanks, Nick. One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
So the dividend stock of the week, ATCO, ACLLF. But first, some disclaimers. Wall Street Hackers is only for entertainment. There's no guarantees, of course, on any investments from anybody. These are only our opinions, and consult your financial advisor. So as people watch Wall Street Hackers know, we love energy and pipelines and getting more and more interested in selected utilities. Why? Number one, because we don't believe the narrative that energy is going away soon or fossil fuels, because developing countries around the world need fossil fuels and more fossil fuels over the next decades. Number two, I believe it's the only place to get high or reasonable dividends and income, and often high, with growth and a lot of relative stability. So to me, it's the number one place to be, and that's where our largest allocations are. Wall Street Hackers has been, and if you watched, been favoring especially large allocation to pipelines like MPLX, very large allocation, number one, and EPD, where we have a 7% allocation right now, and also royalty trusts like KRP, which we just increased. Maybe we'll do that next week. But now we're going to focus more on most coming weeks on utilities and also Canadian investments in energy and utilities. The opening of Canadian pipelines to the west is going to transform the Canadian landscape in terms of energy. It gives them a place to flow out their energy resources, where before they were kind of landlocked and they had to send to the United States. That will help the producers. It will help the utilities. China, Japan, and India have a desperate thirst for natural gas liquids as a way to reduce their tremendous problems, especially China, with pollution. And so there's a huge thirst for it. Canada has it, and they're going to be sending it more to Asia. So Wall Street Hackers has a 0.5% allocation to ATCO. ACLLF is the abbreviation. It's a large Canadian utility and has a lot of focus on the Alberta energy producing region. It has a 4.8% yield, which is pretty high, not as high as we always like, but we take lower yields with growth. And a warning to U.S. investors: if you're a U.S. investor, there will be 15% withholding tax. I don't know about other countries, probably not in Canada, or probably is in Canada, but you have to pay the tax anyway. But it can be avoided in an IRA or a 401k or qualified plan. But, that's a penalty that can add up. So I put it in my IRA, basically, or a 401k. So according, E-Trade, it has phenomenal cash flow of 2.4, which is 41% cash flow yield. But I tried to confirm that at some other sites, and I can't even get cash flow yields anymore. TD Ameritrade became Schwab, and they don't have it that I could see. So unfortunately, that's what it says, but maybe they did a special deal or something that generated it. But the thing I do know is you can look up their dividend history, and it's been really healthy in terms of growth. And that's what you want, 4.8% yield that doubles every 7 years, or whatever it is. You can look at the history. Very steady, and to me, very safe. That's what we look for. And also, the thing I like about it is any utility in the Wall Street hackers model is northern based. Why is that? Because there is a great deal of uncertainty in the utility industry because solar is coming, and it could disrupt the whole industry. You can read articles about that. So bottom line, I like ATCO. Why not more than 0.5%? I better mention that because of the possibility of wildfires. That area of the west of Canada can have huge wildfires, and because of some court cases recently, ATCO might have liabilities there. So for 0.5% with growth, I'll take the chance. I think even if there were fires in the long run, they'd be fine. But I don't like risk at all. I like sure things. So I'll go with 0.5%. Panel discussion of the week. Hey, Kim.
I'm here in time. Hi.
You are. You made it. And we have 3.5 minutes, so we'll have to move it a little bit, but I think we have more time to continue this discussion. So the discussion we began last week is what is going on with U.S. colleges and what can be done about it. Quick background, because we covered it last week. Number one, as most people know, there's current chaos on many U.S. campuses, although it's fading a little bit. Number two, many students believe in anti-American slogans and neo-Marxist slogans. These are often permeated and promoted by professors and administrators at the colleges and schools. What everybody knows just about in the world is tuitions at colleges are astronomically high, sky high, and they've far exceeded the growth in consumer price index for decades. And they're obviously affecting the middle class, and they affect people of all classes because it's outrageous how much it costs. Maybe there's value there for some people, but it's very expensive. So finally, this week, a poll said 65% of students support the recent protests. So you might believe in the protests or not, but here's what the poll also said. 36% of those who support the protests support using violence, and 35% back using hate speech. Let me repeat that. 36% of these protesters in the poll support violence, and 35% support hate speech. What are these colleges teaching? So we've got 2.5 minutes. Kim,
I think that some of the people who reply on these polls aren't being honest. I think they're just being, outspoken in the wrong way. I don't think they really support violence. I think they're just being obstinate, as Nick would call it. But hear me out on this. I think it's very important for the students to have an outlet to speak about their concerns about the society, because they are spending a fortune on their education. They're getting absolutely no return on their investment. In fact, it's costing them more in their livelihood and
it's outrageous. So what do we do about the colleges?
So I think, close them down.
Close them down.
No. So okay, be realistic about your investment. Okay. Be more realistic. Read the contract that you're given before you sign it, which students aren't taught to read contracts.
Right. Yeah, know what you're getting into.
PPP loans to people who could read contracts that had terms and conditions and then waived them. So, you're not giving children an opportunity to even know what they're getting themselves
You're right. They're getting into hundreds of thousands of debt. And unfortunately, we have 45 seconds left. As always,
if I were them, I would be stoning the school probably.
Well, let me give my fast conclusions. Number one, the universities have gotten fat and lazy because of government subsidies and grants and loans. Professors live in a socialist society to begin with. They have many of them have tenure and guaranteed jobs like socialists. Many of them teach very few hours, and they devote themselves to studying their favorite fields instead of at the middle class expense. And tuitions are sky high. The U.S. has to start stop subsidizing so much. They need to phase it in, and the U.S. government can't afford it, and we're out of time. So
And take
thanks
money
for,
away from
as
the
Kim always
wars and
says,
feed the
you got to
students
go,
with.
Kim. As Kim always says, get healthy, get wealthy. We'll
And
see
we'll
you
see
next
you
week.
next week.
Maybe we'll finish up next week.